After 7 straight weeks of losses, US stock indexes ended one of the worst sell-offs in history. The S&P 500 had its worst 100 days to start a year since 1970, and the Nasdaq had its worst first 100 days ever in the history of the index. While some are betting that the worst is over, I'm going to tell you why there could be more selling to come. We'll break down how this sell-off compares to past downturns, provide some insight on where things stand for the US economy, and detail why things are likely uphill from here. Let's get into it. There have been comparisons between this sell-off and the dot-com bubble burst. If 2022 is anything like those days, there's a lot further down to go. From the peak of the bubble in 2000 to its trough in 2002, the Nasdaq fell 78%. At its lowest during this downturn, the Nasdaq had fallen 32% from its most recent high. Further, companies like Tesla, GameStop, and other tech favorites are still showing incredibly high valuations. GameStop has a market cap of $10.5 billion. That's larger than household appliance juggernaut Whirlpool and Hyatt Hotels. Tesla still has a market cap of nearly $800 billion, making it worth more than every other car company in America combined, even though it sells less than 5% of all cars in America. So what's the current state of the US economy? While the market downturn we've seen has been significant, businesses are holding up well. US corporate bankruptcies were the lowest they've been during the first quarter in at least 20 years. And the percentage of businesses that are delinquent on their loans remains historically low. Consumers are also healthy, according to credit agency TransUnion, which described American consumers' credit recently as strong. Retail sales, bank deposits, and other measures of consumer spending have also held steady or increased so far in 2022. That all suggests the stock market's losses have done limited damage to the real economy. That's a good thing. But it also means the stock market is unlikely to get much help from the Federal Reserve in the near term. The Fed has only raised US interest rates twice, from nearly 0%. And when factoring in inflation, rates are still negative. So throughout all the turmoil in markets, the Fed had been providing accommodative monetary policy. That's about to change. Starting in June, the Fed will begin what's known as quantitative tightening, meaning that rather than pumping money into the economy, they're sucking it out. And minutes from the Fed's latest meeting show, the central bank is considering moving towards restrictive policy levels, meaning raising interest rates high enough that they restrict economic growth. That's something the US hasn't seen in a generation, and it could put more pressure on stock prices. But on the bright side, markets are forward-looking, so this may have already been factored in, and there's a chance that the worst is behind us. But there are certainly some bumps up ahead. The legendary Big Daddy Kane told us all in 1992, "I gotta take control of my own destiny, control what I hold, and of course, be the boss of myself. No one else will bring my wealth." That's all for now. I'll see you next time.